to retire early. Now, I've become obsessed with helping people to retire early. And it's because in my 24 years as an investor, I've seen too many people with financial regrets, too many people struggling in retirement. And one of the main reasons is because in the UK, we're a nation of savers. This is a huge problem. When you fully understand things like compound interest and inflation, you invest into assets. It's as simple as that. Currently, in the UK, there's over £1.9 trillion sat in current accounts and cash ISAs. This is leading to people struggling in retirement because we're a nation of savers. Over 70% of people can't maintain their lifestyle, their current lifestyle in retirement. Worse, 1 in 4 people can't afford their basic needs. This is a shocking statistic, but you don't need statistics from me. Just look around at friends and family. I can almost guarantee people will be struggling in retirement. What about you? Let me know in the comments if you know anyone, friends and family, who are struggling in retirement or as they approach retirement. Now, today I'm going to be telling you all about the 5-step plan to retire early. If you want this in greater detail, look at my new playlist, How to Retire Early. Basically, you're getting 5 10-minute videos to help you with my 24 years experience to help you retire early. But before we get to the 5-step plan to retire early, I'm going to give you a personal story of why investing into assets is massively important. I'm going to tell you about my dad. My dad's 62 years old, and unfortunately, he has to work every single weekend. He's working 6 or 7 days a week to build his pension pot up because he feels he hasn't got enough saved for retirement, to live a comfortable retirement. Now, this is painful for me to watch. It's painful for me to watch him working every weekend, but not only that, he's got health issues, like the fact that he needs 2 new knees. He's struggling. And I'm sick of seeing things like this time and time again. Now, looking back on my dad's life, he could have easily saved £500 a month. He's been on good jobs, he's earned good money, but because he wasn't financially literate, he didn't have any financial education, he didn't, unfortunately, invest into assets. Now, let's imagine my dad was financially educated like 30 years ago, and he did invest £500 a month into a low-cost index fund, for example, like the S&P 500. If he'd have done this, if he'd have invested £500 a month, let's assume he got 10% returns on average, which is in line with historical data. If he'd done this for 30 years, he would be sat on over £1.1 million, a huge amount of money, and this would mean my dad could retire at 62 easily. Hopefully, this demonstrates the importance of investing into assets. What about you? Are you an investor or a saver? Let me know in the comments. And if you're not an investor, why not? So, the 5-step plan to retire early, again, which can be found in my new playlist here on YouTube, is all about money mindset, personal finance, financial literacy, mistakes to avoid, and how to retire early with index funds. Step 1 is money mindset. Mindset is first because it's massively important. It's important with anything you do, especially investing. Now, unfortunately, for the first 35 years of my life, I had a negative mindset, especially around money. I was always negative about money. I was always too emotional, too stressed. I had a fear of failure. But what affected me most, especially in my negative decade between 2008 and 2018, which I'm going to be talking about, what affected me the most was being anxious around money. This is not the way to go, trust me. Now, my negative decade, I had a negative decade between 2008 and 2018 because of poor emotional intelligence. I had a negative mindset with money and a lack of financial education. So what does a negative mindset, a negative money mindset look like? Basically, you whinge about money. You're worried about money. You're bitter about other people with money. You try to keep up with the Joneses, things like that. So I'm going to tell you about my negative mindset in my negative decade, and then I'm going to tell you how to turn things around. So 2008, I'm going to give you a property example of my negative money mindset. Before 2008, before the financial crisis of 2008, I had a small property portfolio. I had 3 rental properties and I was about £50,000 in equity. Now, after the financial crisis, this went from 50,000 in equity to 50,000 in negative equity. So £100,000 swing. This had a really negative impact on me. I didn't invest in property for another 12 years because I'd made a few mistakes in property and I had a fear of failure, a negative money mindset. So this is an example with property. Just in general, I was always worried about money. So at the end of a contract, at the end of a job, I would be worried about my next job, worried about paying the bills. I was always moaning, whinging, especially to my wife, about money worries, about our so-called money worries. And what makes this worse was I earned good money during this period, especially 2012. Now, going back to 2010, I went back to college to get some engineering qualifications, and 2 years later, my income doubled. Now, this was good, obviously, but I was still worried about money because I was clueless. I didn't have any financial education and I had a negative money mindset. Please don't let this be you. Learn from this huge mistake. Now, this went on for years and years, by the way, but by 2018, sorry, I'm just trying to fucking say hi. By 2018, I was sick of my negative money mindset and I was ready to turn things around. This led to much needed personal development. I started watching Tony Robbins videos, Jim Rohn, Les Brown, people like that. By the end of 2018, I set my first ever goals. By mid 2019, I'd read 50, 60 books on investing, mindset, and I was financial literate. And I started investing in the stock market with low cost index funds. So take it from me, if you've got a negative mindset, especially around money, you can turn it around. How do you do it? With books, podcasts, YouTube videos, getting around positive people. Your environment is massively important. Now, what about you? Let me know in the comments. Have you got a negative mindset, a negative money mindset, or are you quite positive? Step 2 is personal finance. So what I'm going to do, I'm going to tell you what good personal finance looks like, and I'm going to tell you what bad personal finance looks like. Good personal finance is where you look at your bank statements, which can be painful, trust me. I ignored my bank statements for years during my negative decade. You look at your bank statements, you get a budget in place. Now, you can do this with a basic Excel spreadsheet, or you can use a budgeting app. Get your budget in place, then you can look at your budget and try and make some cuts. Easy wins include reducing your subscriptions, reducing or removing your takeaways you have each week, reducing your alcohol you have each week, or maybe shopping around at the weekend when you're doing your food shop. So shop at Aldi, Lidl instead of Tesco, for example. So you've got your budget in place. Then you need a cash buffer. Most experts recommend a cash buffer of 3 to 6 months. Once you've got your cash buffer in place, it brings calmness. And when you're calm and neutral around money, it means you're a better investor. It means logical decision making. Trust me, getting a cash buffer in place is massively important. Next is paying off high interest debt, things like loans and credit cards. When you've done this, when you've got your budget in place, you've got your cash buffer, you've paid off debt, you're almost ready to invest. Now I'm going to tell you what bad personal finance looks like. And I'm going to tell you about what I was like during my negative decade between 2008 and 2018. I was terrible with personal finance. I'll give you an example. So I didn't look at my bank statements much. I didn't have a budget in place. Now, I got BT Sport around 2013, 2014. I only got it because I wanted to watch Conor McGregor UFC fights. I had BT Sport for 3 years, and in that time watched about 3 Conor McGregor fights. Now, I thought it was £10 a month, but it wasn't. Turns out it was £30 a month because I wasn't checking my bank statements. So I spent hundreds and hundreds of pounds on 3 Conor McGregor fights. This is bad personal finance. Now, another example of bad personal finance is lifestyle creep. So as I've said, my income doubled in 2012, but unfortunately by 2014, lifestyle creep kicked in. Basically, lifestyle creep is where your income increases and then your expenses increase to match your income. And this is where you're month to month. In my 25 years as a contractor, I've met hundreds and hundreds of contractors who let lifestyle creep kick in because they get the latest car, they go on loads of holidays, get the bigger house, etc., etc. I've met lads on 150,000 a year, even 200,000 a year, who are living month to month because of bad personal finance, because they're clueless with money management. This is what not to do. What about you? What's your personal finance like? Let me know in the comments. A really bad example of bad personal finance was me in 2016. So my income dropped considerably in 2016, unfortunately, because I stopped working in the oil and gas industry. I stopped working offshore because of my fear of failure. My income dropped considerably, but our expenses didn't. In fact, they increased. We spent £10,000 on a front room, got a log burner, new sofa, etc., etc. Went on 4 holidays, Lapland and a few holidays abroad, loads of weekends away. We got the latest car. Basically, our personal finances were shit. And the money we had in premium bonds, which was 70,000, went down to about 30,000 in a short period of time because of bad personal finance. Please don't let this be you. Moving on to step 3, which is financial literacy. Again, this sounds about as boring as personal finance, but again, it's massively important before you start investing. Financial literacy is what we should have been taught at school. We should have been taught about economics, macroeconomics, about inflation, about how inflation can have a really bad effect on everyone. We all know how bad inflation is. Just look at your food shopping each week. Look at how much it costs each month to spend on food compared to a few years ago. That's inflation, or one of the things, inflation. Most people don't factor currency debasement because they're not financial literate. When you're financial literate, you learn things like stocks, bonds, property, index investing. You learn about loans and credit cards. You learn about interest rates. One of the things that we don't get taught is compound interest. This is one of the most important things. If you learn about if you fully understand compound interest, you invest into assets. That's my opinion. I'm almost certain that would be the case. So to drive home the importance of financial literacy, I'm going to give you two more examples. Going back to 2014, when I was clueless and had no financial literacy, I did have £70,000 in premium bonds because of that increase in income. But in 2014, I had a tax bill of £10,000. And instead of using my premium bonds money, I got a loan. So on one hand, I'm earning less than 1% interest with my premium bonds. And then I go and get a loan where I'm paying 8% in interest. So obviously, this was a time when I was clueless. Not only that, I'd done this 2 years in a row because I didn't fully understand interest rates. I didn't fully understand loans and credit cards. Please don't let this be you. What about you? Do you fully understand interest rates? Do you have loans and credit cards? Let me know in the comments. Now I'm going to give you an example of compound interest. So let's say I was financial literate after leaving school and when I started work. I know I would have invested into a low-cost index fund, for example, between the age of 18 and 42. So that's 24 years. In fact, I did start investing as an 18-year-old. I invested into a stocks and shares ISA, £500 a month for 6 months. But unfortunately, I stopped investing and spent all my money on a lad's holiday to Ibiza, I think it was, or maybe it's Benidorm. Yeah, Benidorm, I think it was. We had a class time, but it was a huge mistake because I stopped investing. Let's assume I kept on investing £500 a month. Let's assume I invested in the SP 500 and got average returns of 10%, which is in line with historical data. If I'd have done this for 24 years, I would have ended up with over £590,000. This would have meant I would be financially free at 42 years old because I could have bought, for example, 5 rental properties in the area I live outright, and I would be making about £4,000 a month, and I would still have £90,000 as a cushion. This is what financial literacy can do for you. Please, if you're not already, become financially literate. Watch the YouTube videos, read the books, learn about things like inflation and compound interest. And if you do that, I'm confident you will invest into assets as soon as possible. That's what I'm trying to do with this live stream. I'm trying to get you to invest into assets. Again, if you want this information in greater detail, look at my most recent playlist, How to Retire Early. You're getting 5-10 minute videos. You're getting all of my experience. All I would say is to watch them in order and maybe take some notes. Moving on to step 4, which is mistakes to avoid. Unfortunately, this is where I come into my own. This is my specialty because in my 24 years as an investor, I've made far too many mistakes, painful mistakes. Just look at my negative decade. Instead of investing into assets, I invested into premium bonds. Excuse me. I had £70,000 in premium bonds for 4 years, earning me less than 1% interest. Me and my wife had £70,000 in premium bonds in total. I didn't invest in a property for 12 years. I didn't invest in a property during this period, and I missed out on huge potential opportunities. So at a time when interest rates were at or around 0%, instead of investing into low-cost index funds, for example, I was chasing quick, easy money with football bets at the weekend, lottery, scratch cards, etc., etc. I didn't invest into a single asset during this time. Huge mistake. Please learn from this mistake. What about you? What's your biggest investor mistake? Let me know in the comments. Now I'm going to give you 2 of my biggest mistakes that I've made over the last 24 years. One was in the stock market and one was in crypto. So going back to 2010, when I first started working offshore, I got around other lads who were investing into individual stocks, and they were all talking about one stock in particular called Rockhopper. Lads had made fortunes with Rockhopper, 100,000, even £200,000. FOMO kicked in. I wanted a piece of the action. So I steamed in without doing any research. I invested into JJB and a few oil exploration companies. And long story short, over a period of time, maybe 10 months, 11 months, I lost our life savings. So this was in mid-2011. I lost £8,000 chasing quick, easy money, investing in individual stocks without doing any research. What makes this miserable little story worse is that my wife was due to have our second daughter, and we were about to move into our second home. Let's just say I wasn't flavour of the month. Please learn from this mistake. If you want to invest into individual stocks, high risk assets like individual stocks or crypto or forex trading, whatever it is, make sure you fully understand what you invest into. Make sure you do your research. Please learn from this mistake. Moving on to my second biggest mistake in crypto. So I got into crypto in 2017. Made some mistakes in 2017 and 2018. And because I'd made mistakes, I didn't even look at crypto for 2 years. So I missed out on huge opportunities again. I buried my head in the sand like the proverbial ostrich. Please don't let this be you. By 2020, I was ready to get back into crypto because I was financially literate. Read loads of books, watched loads of YouTube videos, listened to loads of podcasts, and by the start of 2021, was ready to invest into crypto. I invested £20,000 into 10 well-researched cryptos, including Ethereum and Solana, made really good money over the course of the year. But unfortunately, I made a huge mistake in April. So going back to March 2021, me and 10 of the lads I was working with at the time invested into a meme coin, a shit coin called SafeMoon. I invested £2,000, and 6 weeks later, my £2,000 went up to £68,000. Now, on this one particular day in April, mid-April 2021, The 10 of us were sat in one room. We weren't doing our job. We weren't working. We were looking at the charts. We were looking at SafeMoon. Now, as I've said, my SafeMoon got up to £68,000. One of the lads went up to 110,000. One of the lads 230,000. One of the lads invested £11,000 and his SafeMoon went up to £68,000. Lads from across the site were coming in, Meckies, Tiffies, shotting 20 grand in, 30 grand in, without having a clue what SafeMoon was. Now, none of us, unfortunately, cashed out. Huge mistake. We didn't cash out then. We didn't cash out a week later. We haven't cashed out 4 years later. Huge, huge mistake. So I missed out on £66,000. But what made this worse was it affected me emotionally. I was anxious, stressed out. I wasn't present in the moment, shall we say, at home. I was looking at CoinMarketCap literally every 5 minutes. This went on for weeks and weeks. Please learn from this mistake. If you do get into crypto, do your research. If you do make considerable profits, you need to cash out. You need to take profits along the way. This is the biggest lesson I've learned in my 8 years as a crypto investor. So there's some mistakes for you to avoid. Again, if you've got any mistakes, let me know in the comments. Let me know your biggest mistake to date as an investor. Step 5 is how to retire early with index investing. By far, this is my favorite way to invest because it's stress-free, it's diversified, the costs are low, there are loads of benefits. But what are index funds? Well, index funds is where you own a small slice of several companies within one fund, like the S&P 500, for example. Or you could invest globally into a global fund and get exposure to thousands, literally thousands of companies within one fund. Let's compare that to individual stocks. Let's say you invest into one company, like me back in 2010, 2011. You invest into one company and that company goes tits up, it goes bankrupt. In this situation, you could lose some or all of your money. This isn't the case with index funds because your risks spread out or with hundreds of companies, if not thousands of companies. So that's what index funds are, but how do you buy them? Well, in the UK, you buy them in a tax-free wrapper. So that's a stocks and shares ISA or your SIP. Then it's what platform to use. You could use Trading 212, Vanguard, Hargreaves and Lansdown. There are loads of platforms to choose from. If you want to compare platforms, head over to Money Saving Expert, and one of Martin Lewis's articles, he compares platforms. The main thing I would say is to look at costs. Keep them costs low. That's what drew me to Vanguard, because the costs are low back in 2019 when I first started. And then it's what to buy. So I've invested into the Life Strategy 100 fund since 2019. And this gives me exposure to 7,000 companies within one fund. So it's really diversified. And then once you pick your fund, it's set and forget. And if you're financially literate, so let me go back. If you've got the right money mindset, if you've got your personal finances in order, if you're financially literate, if you're happy to make mistakes and learn from them, you're ready to invest. Once you pick out your index fund, like the S&P 500, for example, you invest for long periods. Long-term investing is how you build wealth. If you've got the discipline to invest for long periods, you can build wealth. This is the simple plan to retire early. Money mindset, personal finance, financial literacy, mistakes to avoid, and investing with index funds. Again, if you want this information in greater detail, look at my new playlist, How to Retire Early. That's what I'm trying to do with this live stream. I'm trying to funnel you towards my latest playlist, but I'm also trying to encourage you to invest into assets. And to finish off, I'm going to give you one more example of compound interest. I'm going to tell you about my mate Gary. Now, going back to 2020, when COVID first kicked off, I was stuck over in Oman for 12 weeks. Couldn't get home, and I was anxious. I was worried about my wife and my kids. This was the most anxious I've ever been. It was brutal. We were all worried. It was brutal for everyone. I was stuck in Oman for 12 weeks, and I was working with hundreds of contractors. And one of them contractors was a bloke called Gary, my mate Gary. Now, Gary was 60 at the time and he was full of regret, mainly financial. And he was quite bitter because all his friends had retired in their early 50s and he was stuck in Oman, in a place he didn't want to be, doing a job he didn't want to do, that he had zero passion for. Excuse me, itchy nose, hay fever kicking in. One of the things he told me was that he could have easily retired. He could have easily invested £1,000 a month between the age of 40 and 60 because he'd worked abroad, he'd earned good money, blah, blah, blah. Now, let's assume my mate Gary was financially literate at the age of 40. Let's assume he invested £1,000 a month into the S&P 500 and he got average returns of 10%, which again is in line with historical data. If he'd have done this, he would have been sat on £759,000 as a 60-year-old. He would have been happily retired. Now, hopefully 5 years later, Gary's got his act together and he is retired. But I've got a feeling he isn't because he wasn't focused on financial education. Hopefully that drives home the importance of investing into assets and is another example of compound interest. You learn about things like compound interest, you invest into assets. It's as simple as that. Now, if you need any help and support with investing, money, personal finance, let me know in the comments. Watch my videos on YouTube. Go and have a look at that playlist. My latest playlist, 5-10 minute videos to help you retire early. All I would say is, again, watch them in order and try and take some notes. Please, even if you're not going to watch my videos on YouTube, please invest into assets. And if any of this information resonates and you want to take our relationship one step further, you can join my free investing community on School. There you're getting six courses for you to complete to help you with that financial literacy I keep talking about. And once you complete the course material, you can ask me any questions in the comments. You're getting around hundreds of like-minded investors and you're getting one-to-one help and support. Like, you've got the option of having a one-to-one call with me to discuss your investments, your money mindset, things like that. Anyway, that'll do for now. Hopefully you've taken some value from this live stream. Hopefully you invest into assets. And fingers crossed, you can retire early, because I'm sick of seeing people struggle in retirement because of a lack of financial education, because they're savers, because they don't invest into assets. Please, please invest into assets. Don't be like the vast majority of people in the UK who save money, or worse, leave it in current accounts. You need to invest into assets. That'll do for now. Thanks for watching.